Earnings season continues to surprise with some incredible growth numbers coming from some of the world's most well-known companies. Plus, an ex-Sydney University student turns down an eye-watering salary from Mark Zuckerberg. Pimp My Portfolio is back as a community member puts their portfolio under the microscope with none other than Luke Laretive here to provide some advice on how they can improve it. And we look at some of the biggest hedge funds around the world and the common stocks that they are buying and selling in Q2. Welcome to Equity Mates, a show where we explore what's possible in the world of investing. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode after that long intro. We're trying something new here. We're trying to tease what's happening in the episode up top, but that tease was
well, everyone knows what's coming.
It was more than a tease. It was a bloody novel.
Yeah, that's good.
But look, we've got other reasons to be excited as well, other than just today's episode. We are growing the team here at Equity Mates.
We have 2 job openings available. The first, Ren, is a research analyst. Now, if you're naturally curious, if you love learning and you can turn complex ideas into clear, engaging content, then Equity Mates is the place for you.
That's right. Across podcast, video, written and social media, we produce a heap of content here, and we're looking for 2 people to come and help us. So if you're interested, if you're naturally curious, if you love markets and business news and everything that's going on, and you want a job where you can just learn about it all day, this is the job for you.
That's it.
But that's not all. We are one of the largest producers of podcasts here in Australia, and we have ambitions to produce more, and we need help on the audio production side to do just that. So we are also hiring an audio editor. So if you're interested in coming and joining the production team, head to equitymates.com/careers. All the information will be there, and you can apply there as well.
News and markets.
Headlines we're covering this morning, we're looking at some of the incredible earnings growth coming out of some companies during reporting season. We're going to look at the Figma IPO, plus an eye-watering salary that has been turned down by an ex-University of Sydney student. Ren, let's get into it.
Let's do it. So earnings season is in full swing. If you're new to investing in America, every 3 months, public companies report to their shareholders how they're going. In Australia, we get some companies that report every 3 months, but most report every 6 months. We're right at the start of Australia's reporting season, but we're right in the teeth of America's reporting season. As of last Friday, so the numbers have evolved a bit from there. 2/3 of the S&P 500 have reported. Pretty good, surprisingly okay, I think is how you would summarize it. 82% have beaten earnings expectations, 79% have beaten revenue expectations. Now that some of the big tech boppers have reported, the average earnings per share growth year on year, a scratch over 10%.
Yeah.
Not bad.
Great. Good on him.
Yeah.
So we've pulled out some of the most exciting companies that we like speaking about, some of the companies that are probably in your portfolios. And we'll start with Reddit, Ren.
If they're not in your portfolios, you may lament them not being in your portfolios, like I did when I looked at some of these numbers.
Good segue, Reddit. I feel like every quarter we lament not having this in our portfolio.
It's like top 10 most visited website in the world.
Yeah.
It trades at a fraction of its social media and big website peers. I think it trades at a similar price to Pinterest, much bigger than Pinterest, and it got a lot bigger over the past 12 months.
It did get a lot bigger, yeah. So year-on-year revenue growth up 78%.
Nuts.
$500 million in revenue for the quarter, $89 million in net profit. Daily active users up 21%. As you said, Ren, one of the most visited websites in the world. And the share price reaction, an outstanding result, up 20% on the news.
Add Reddit to the long list of companies that we're going to lament not buying as they went from unprofitable money losers to making consistent profits.
Yeah.
Spotify, Shopify, Uber, Reddit.
Zip.
It's just... it was staring us in the face. Luckily, I got on some of them. I think you got on some of them as well. But we could have stuffed our portfolios full of them.
Yes, big time. It's not too late, but I mean, that strategy is definitely one to keep in mind. The next one, Apple, 10% year-on-year revenue growth. It hit a record $94 billion in revenue for the quarter and an all-time high earnings per share, noting what Ren said earlier around earnings per share growth of $1.57.
Yeah, if you just told us that Apple hit records in profit and earnings per share, and then you looked at some of the commentary around Apple about, how it's best days behind it and all of that. The numbers kind of tell a different story. Obviously, like, it's probably at its peak.
Yeah. It's
plateauing.
It's plateauing.
The share price was down 5% as investors
weren't
stared into the plateau.
Yes. We've spoken about Nintendo. Now, they released their Switch 2 gaming console during the quarter, and revenue was up 132% year on year. They sold 5.82 million units of Switch 2, $3.8 billion in revenue for the quarter. Share price is up 42% year to date. The share price reaction on the news, I would say, muted.
Yeah, a lot of it is known. It's
built in.
Yeah. So we knew like 4 or 5 days in that the Switch 2 was doing well. And I think for long-time Nintendo watchers, it's important. This has been massive because Nintendo can never go back to back.
Yes.
They did they did the Nintendo 64.
Yeah.
Killer console.
GameCube?
Followed it up with GameCube.
Yeah.
They did the Nintendo Wii.
Yeah.
Killer console. Followed it up with the Wii U,
2 or whatever.
I think.
Something.
Nintendo's history is a really great console and then a dud.
Yeah.
And so the Switch, great console, sold well. And so everyone was like, can they finally buck the trend? It took ages to get the Switch 2 out, and it looks like they've done it.
Yeah.
I think it's their best-selling console in the first week or something.
It's incredible. I think they reckon they're going to sell about 15 million units, so plenty more to come. Let's have a look at Amazon. 13% year-on-year revenue growth, $167 billion in revenue. Their cloud services, AWS, $30.9 billion. However, their profit guidance was weaker than Wall Street expected, and their cloud growth was underwhelming. So their stock actually fell 8% on the news.
So one that I've actually got in my portfolio that had a muted report was Coinbase. Revenue was relatively flat, about 1.4 billion in revenue. It had gains in subscription revenue, but there was pretty weak trading volume. The market didn't like it, down 9%.
A Mr. Beat Up special there. Pretty compelling when he came in.
To be fair, it's had a very good run.
It has. Yeah, absolutely. And then to close out, Roblox. So we spoke about this recently on the show. Revenue up 21% year on year. They had strong bookings, which is effectively their figure for in-game buying of their currency or their coin, up 51%. And their daily active users up 41%, as well as their hours engaged up 58%. That's what got the investors excited, with the stock up 17% during trading, closing up 7% for the day.
Yeah. I mean, my takeaway from all of this is there's plenty of companies growing very quickly, and if you spend the time looking, you can find some winners.
Absolutely.
And I mean, look, they're all very well-known companies, let alone the long list of companies that don't have such name recognition as well. Yeah. So I think there's a lot... There's a lot of interesting stuff happening in earnings season. One thing that I think is bubbling along the surface that I think is worth paying attention to, particularly in Australia, where we're obsessed with the inflation story and what that might mean for interest rates, and we're all banking on interest rates coming down. A number of companies are talking about tariff-related price increases.
Yeah.
And that is just consistent commentary we're hearing, and like a lot of companies will raise prices without putting it in their commentary as well. So that's something to watch. It's emerging in America. Australian reporting season's about to start. I'm going to be watching that pretty closely, and I'm not banking some of these rate cuts that people seem to be if we start hearing about companies raising prices 3%, 5%, or all of a sudden there might just be some little inflationary pressure bubbling away there.
Yeah. All right, well, moving on to the IPO market, where we've just seen a whopping IPO over in the US. A company called Figma has hit the trading boards. Now, Figma is, think of it as a competitor to Canva. They're like an online design and sort of graphic design studio.
Yeah. So they're more used for like website and app design, whereas Canva's probably more like social media and decks and stuff like that.
Yep.
But they're certainly in that same category of collaborative design platform trying to disrupt Adobe's dominance. Is that fair to say?
Yeah.
And hence why Adobe tried to buy them. I think Adobe tried to buy them for what, about
20 bill.
20 bill?
Yeah.
That was blocked by antitrust regulators. Early Figma investors are probably pretty happy with that because of how this IPO went. So it was a massively oversubscribed IPO. Like people were desperately trying to get their hands on it. I think it was like 40 times oversubscribed or something. Figma priced the raise at $33 a share.
Sorry, and just to dig on that a bit for people who have just joined us, when we're saying oversubscribed, what we're saying is the company's gone out to raise some money. They said we're going to list and in the process raise $1.2 billion. And so they go to investment banks, institutions and say, we're going to try and raise this money. And when you're saying oversubscribed, you're saying many more people came than what they were actually trying to raise.
Exactly. Yeah. And so then they have to cull the list or they decide to raise more. Then there's a bunch of ways they manage it, but massively oversubscribed. The $33 a share put them at about $19 billion valuation. So basically what Adobe tried to buy them at. They opened at $85 a share, got as high as $125 a share. Now they're trading a scratch under $90 a share. So a few takeaways here. First of all, if you got your hands on those Figma IPO shares, you're pretty happy because you almost tripled your money.
Yeah.
Figma investors and early employees that sold in the IPO, probably pretty unhappy that they sold at the $33 share price when they could have sold at $90 a couple of days later. Figma also probably could have raised the price of the round and put more money in their company's bank account, but they're probably not unhappy about how they've gone. But this has an Australian tilt to the story because for years people have been asking when will Canva IPO, and this seems to have not just opened the door for Canva, it seems to have kicked the door down SWAT police raid style. That door is not getting repaired, it needs to be replaced because the door is so open for Canva now. To put some numbers to it, so Figma IPO'd at the $19 billion valuation. They're now above $50 billion valuation. Canva sits right in the middle of that range. I think their latest round priced them at $32 billion US dollars. So for all the investors that were happy to pay those prices for Figma, Canva seems like something they'll also be willing to sort of pay in that ballpark for.
Yeah. One to watch. There's always news articles that pop up. Now's the time for Canva. Have they left it too late? Has Figma stolen all of the enthusiasm from investors? But yeah, it'll be an interesting one to watch. Rumors are late 2025, 2026 for Canva.
Yeah,
but they've been saying this for years.
All right, Bryce, well, let's close it with our What The segment where we share one story that surprised us or caught our eye, a reminder that we feature a What The every day in our daily business news email, which you can sign up to at the show notes or the YouTube description. Remember, it's free to subscribe and you can unsubscribe anytime, but we're pretty confident you won't.
Yes.
So here's what had us asking what the today and maybe questioning our choice of universities. One University of Sydney student graduated in 2011 was just offered $1.5 billion over 6 years as an employment contract, not buying his company, as an employment contract, and he turned it down.
It's crazy. It's crazy. So the guy's name was Andrew Tulloch, as Ren said, ex-Sydney Uni student. Mark Zuckerberg approached him to come and work at his super intelligence lab that he's aggressively trying to hire for at the moment, but he did turn it down. Now, Andrew has a history of working in, AI and the pointy end of engineering. He spent 10 years as a distinguished engineer at Meta before leaving and working for OpenAI. But now he runs his own AI lab called Thinking Machines, where he has a vision for responsible AI rather than, what Zuckerberg might have in mind. So he turned it down. Rumors are, though, that his net worth is already surpassed the $1.5 billion that he's been offered.
Yeah, okay.
So he's probably like, all good, thanks.
I feel like when you're working on such cutting edge technology, like money isn't the main motivator. Probably the motivator is developing super intelligence outside of the control of our big tech overlords.
Yeah, you would think so. But it is wild.
$1.5 billion over 6 years.
Over 6 years. And I think what you said there,
1.5 billion Aussie, we should say.
Yeah,
billion
and an
US.
employment contract. That is what's wild about this. Like Zuckerberg is just throwing money around.
So I listened to an interview with Sam Altman and he made a good point, which is that if you think about it from a company lens, that some of these AI companies have maybe 30 researchers and engineers and they're achieving valuations of, for ease of maths, $30 billion. And so his point was, it feels crazy, but actually when you think about it, if you're willing to pay $30 billion for a company that is primarily just the work product of these incredibly smart people, why wouldn't you be willing to pay an equivalent amount just to hire those incredibly smart people?
True.
And when you think about it like that, it's like, okay, I'm not buying a 30-person company for $30 billion. I'm buying one of their staff for $1 billion.
Yeah.
I mean, it's not a perfect correlation, but it's pretty close.
Yeah.
Yeah.
Wow, what a crazy world we live in. Anyway.
God, why did I go to ANU?
Why did I study music? Anyway. Welcome back to Equity Mates. It is time for...
This is Pimp My Portfolio. Pimp My Portfolio.
This is a segment where we have a community member submit their portfolio for one of our experts to review and provide some ideas on how to improve it. Today in the studio we have Luke Laretive from Seneca. Luke, how are you?
Ricey, Ren.
And on the line we have community member Daniel. Daniel, how are you?
Yeah, good, thanks, guys.
Very excited for this one. We have Luke Raring ready to go. Before we jump into it, can you just give us a bit about yourself?
Yep, so I'm 29 years old. I work in client outreach for a recruitment agency. This portfolio, it started back in 2018, so a while ago. I like to call it investing, but really I just started off just pretty much stock picking and throwing darts at a wall. And, as I've matured a bit, I'm aiming for a 50-50 core and satellite portfolio, and I try to capture about 20% of my before tax income. And that's what this portfolio is doing.
Love that. Well, before we get into the nitty gritty, Ren, give us a bit of insight into Daniel's portfolio.
So Daniel, if he's going for 50-50 core and satellite, he looks pretty bang on. So the core is 8 ETFs that is 51% of the portfolio in alphabetical order. BetaShares Asia Technology Tigers, iShares Global 100, iShares ASX 200, iShares S&P 500, BetaShares NASDAQ 100, VanEck MSCI International Quality, and then that same ETF, but the hedged version of it. And then finally, Vanguard Australian Shares ETF. Then in the satellite portion, in alphabetical order, we've got BHP, Endeavour Group, KMD Brands, Megaport, Nine Entertainment, Pilbara Minerals, Rio, Telix, Global X Uranium ETF, Whitehaven Coal, Woolworths Group, and Yancoal Australia.
Wow,
Yeah, look.
Luke, nickname?
Daniel's Doozra. So,
Daniel's Doozra.
Yeah.
Okay.
Because he just absolutely stumped me. I looked at this, I was like, what is this bloke doing?
All right. Well, before we get your thoughts, Luke, Daniel, I guess just some, further insight into...
Well, why don't you answer Luke's question? What are you doing with the portfolio?
Well, he's explained it. He's doing core satellite and he's picked some stocks, and I get it. So, now I understand. But when I first looked at it, and the way the boys send it through to me, I just sort by portfolio weight. So I don't really see core satellite because it's anyway, that's by the by. But I get it. Now I kind of see what you're doing. So you've got an individual, half of it's individual ETF, picking ETFs, and then the other half of it's kind of picking stocks.
Well, let's start with the core then, Luke. What do you think? There's a lot going on in the ETF side of things. You've got Global 100.
Yeah, Daniel sounds. I like recruiters, and I reckon Daniel sounds pretty smart. I reckon he knows what he's doing here. He's got his weights that he wants. Whether I agree with them or not, who really cares? I don't mind that VanEck International Quality ETF. I like that. Don't know whether you need the hedged and the unhedged version.
What do you think about that?
Yeah, but I mean, that's nitpicking, right?
Yeah, fundamentally, is it worth hedging or
Look, it depends on your setup, right? So say at Seneca, our view on hedging is when we don't pick managers because they have a hedged or an unhedged product. We're going to try and find the best manager to do a particular job for a portfolio that we need. And then in our models, because we can't hedge every product, if that particular manager has a hedged version, we often use it because, we almost always use it because there's going to be another product somewhere in that same portfolio that's doing something different that we can't hedge. So it's we kind of just sort of straddle the fence.
So the idea of splitting the baby between hedged and unhedged is not that's you're happy with that?
Yeah, I'm totally happy with it. It's just in this sort of size portfolio, whether that is necessary, I'm not sure. But obviously you've got some exposure to the US, some exposure outside the US. You've got a bit of a tilt to quality, and obviously this pretty solid tilt to Aussie shares. Fine. You like uranium, cool. It's doing well at the moment. I'm not a big uranium guy, but like if I was going to do it, probably just buy the physical. I think that URNM, is that the physical or is that stocks?
No, it's a mixture of global diversified mining companies as well as some physical in there.
Yeah, I mean, I've plugged it, I think, on here before, but the Sprott Trust you can buy in the US. I don't know whether you can buy it here, but I'm sure you can. You know, these guys are just trying to pillage as much money out of people as possible.
For uranium, you're saying buy the physical, but then for gold, you were saying sell the physical and buy the miners.
Yeah, and that's for a reason, is because I think the companies in uranium, about 2 or 3 of them, the very kind of large ones that are established, are pretty expensive for what they are. If you forget about that they're mining uranium, just say like we're mining, we're digging up dirt, we're selling for a margin, you know, we've got this CapEx budget to spend to be able to keep mining. They all kind of just look a bit shit to me.
Right,
so, and they're pretty big weights. These ETFs, these uranium ETFs, the way that market's segmented, it's actually, you end up with quite a lot of stock. You end up with a lot of money invested in it. Well, so I'd rather, if your view is that the uranium market's fundamentally it's going to be growing and demand's changing and we're going to start using heaps of nuclear, well, the uranium price needs to be, the incentive price to mine it needs to go higher. So, you know, you can just own the physical or a leverage version of the physical. Whereas like in gold, say, for example, you've got high prices. Really, we're at the late cycle of a gold market. Like if you want to bring it back to this other combo, you really want to benefit from the cash flow. You know, so it's you're at the early stages of a uranium cycle. You're at the late stages of a gold cycle. So it's different for two. Anyway, so that's kind of that. Do you want to talk stocks? Because it's kind of everything else is kind of boring for me.
Well, I guess, Daniel, do you have any questions for Luke?
I want to hear Luke's opinions on my 3 international holdings here, not to split hairs here, boys. I just want to make sure he knows that I've got those 3 holdings too.
What are they?
Match.com, CrowdStrike, and DRAG, which is the diversified Asian markets ETF with a large holding in BYD, Alibaba.
So I'm going to throw my co-host Bryce under the bus here, who prepares these sheets. I think they fell off the sheet.
Don't have them.
Yeah, don't have them, Daniel. And to be fair, mate, like, you know, could I give you an educated opinion about those things? Sure. Am I an expert? No. So, like, I'm a big believer in that, like, not all opinions are equal and we shouldn't listen to them all. Yeah. You can have one, but I don't have to care about it. And I don't think you should care about my opinion on BYD. I just don't think I'm the best person to speak to. Whereas, like, you can ask me your opinions on Megaport. Like, I know that well. You know?
Well, you do focus your research on Aussie stocks. Yeah. So why don't you give us your view on some of these Aussie names?
Okay, so, like, you know, BHP Rio, fine. You know, I don't really understand why, if you're an individual investor and you've got 10 slots in your satellite portfolio or 15 slots in your satellite portfolio, you would own anything in the top 20. I really don't. I don't understand it, because the only reason I own BHP and Rio, realistically, or any of the big 4 banks, is because I've got to manage my benchmark. So it's really hard for me to be like, yeah, I'm super excited about what's going on at BHP and Rio. It's just, you know, something to think about. If I was just going to pick pure stock picking, 10 slots, highest conviction ideas, most outperformance opportunity, it's not going to be those names. Even if you think commodities are going to rip, there's more leverage, better versions, more growth, blah, 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 cheaper. That's that. Same with like Woolies. Like, no fund manager actually wants to own Woolies. Do you know what I mean? We don't actually want to do it. The problem is that you guys all every month want to be like, why aren't you above benchmark? So that we have to own Woolies to be able to make sure that we're above benchmark when Woolies does something stupid one month and we have to, we miss out on it. So that's that. I think you're kind of barking up the right trees, more like the size and potential of like a KMD brands, Endeavour, Megaport, Pilbara, and the coal stocks. You got like Antelix, like, so, better. Are they my favourite stocks in the market at the moment? I think Megaport looks okay. It's kind of getting expensive though. We've made pretty good dough out of that recently. Endeavour, again, like super like boring, kind of slow moving business that's not going to probably generate a lot of alpha. I think even if you had a really strong view on rates and a defensive low growth, maybe, but I probably would think that's not my view at the moment. TLX is a good business. They've done, it's doing great things. I don't know whether that's the best way to play pharma at the moment. We kind of like Neuron at Seneca at the moment, and we think you're paying a lot for TLX when you can kind of pay for the existing drug and you get the second drug for free kind of thing at Neuron at the moment. So that might be worth looking at. Coal sector, interesting for me. Like, I'm a coal nerd, so Whitehaven and Yancoal, like the two that I wouldn't own, ironically. So, we would own Stanmore, New Hope over both of those. I'd even like, and this is super spicy. I do not recommend this anyone go, but like Coronado, CRN, it could go to 0, but it also could 10 bag. So it's kind of like interesting at the moment. We're kind of trying to figure out whether we need to own that or not. TBD on that front. Look, it's, if you like these stocks and you've done your work on them and that's your view, everyone's got a view. It's not necessarily the names that I'd pick, but like I can see why you'd own some of these things.
So, Daniel, as we wrap, I think some of my big conclusions. First of all, the fact that you're investing 20% of your before tax income is something to be really commended. And I think like you do that over a long period of time, you're gonna do all right. So start there. 50-50 portfolio split. Luke seemed to like your core portfolio. So I think there's some good things there. Think about the overlap, like you've got Vanguard, Aussie shares and iShares, Aussie shares as well. Luke questioned some of the big holdings and whether you need them if you've already got those exposures through the ETF. But he seemed to like some of the smaller names to an extent, or at least the areas that you're playing in.
Yeah, I like the area. You're bowling in the right areas, but, maybe just if, not quite getting the rub of the green at the moment.
Yeah, I think you mixed your sporting metaphors there, Luke.
There we go.
Anyway, Daniel, we want to say a massive thank you for joining us today and all the best with your investing.
Yeah, thanks for that, guys.
If you would like to submit to Pimp My Portfolio, head to equitymates.com/contact. There's a form there for you to fill in. If you'd also like to speak to Luke and the team or any other advisors that are in our network, head to equitymates.com/advice and we will connect you. But Luke, as always, great to chat.
Thanks, boys.
A cheat sheet is a quick reference guide or concise summary of important information. Usually designed to help someone quickly recall key points, formulas, commands, or concepts.
There are some common themes and stocks that the biggest hedge fund managers and investors from around the world have been buying. So we've dug into the 13 Fs of Stanley Druckenmiller, Tiger Global, Lone Pine Capital and Berkshire Hathaway to find out where the money is going.
Nice. Where are the big investors putting their money? It's a pretty great resource, 13 Fs.
Yeah.
For people who are unfamiliar, every quarter, a certain period of time at the end of each quarter, these big investors have to disclose their holdings. Now, there's a couple of caveats. One, there is a bit of a delay, so, we don't know when they're selling. And two, it's just what they're holding at the end of the quarter. So, if they're trading frequently, it's not like they're all long-term positions. But with those two caveats in mind, they do still give us a pretty good insight into what's being bought, what's being sold. And particularly if you look at 13Fs over time, you can start to see where those long-term holdings are. So let's start with what are some of the big buys that we're seeing.
So the most common buy among some of the big names that we spoke about, as we said, we've got Stanley Druckenmiller, Tiger Global, Lone Pine Capital, is AppLovin. The ticker is APP, bought by those three big players plus a number of other smaller hedge funds. A company that I actually hadn't heard of before.
Yeah, so this one, excuse my French, this one shits me.
Oh, really?
So for context, it's up about 480% in the past 12 months.
Oh,
it's
shit.
Killing it. But I remember when it IPO'd.
Okay.
It IPO'd in 2021, right in the teeth of the everyone can make money boom.
Okay.
And I just looked at the name of it, AppLovin. Like, it's like McLovin from Superbad. It's like, it doesn't even have a G at the end. It's Lovin. It's one word, AppLovin, Lovin. And I remember seeing it at the time and being like, God, anything can list these days. This was in the SPAC era and it fell in 22, 23 and it came back. But look at its like long-term chart. It's just nuts what has happened.
Damn it. Well, I mean, we were going to talk about it afterwards, but we may as well now. If you haven't heard of it, like I hadn't, it's a leading mobile tech company that offers like full stack platform for mobile app developers to market, monetize, analyze and publish their apps. So an environment where you can take an app from go to woe. To put some numbers to it, they support 2 million apps around the world and they provide advertising opportunities.
I reckon like the best way to think about it is, do you have like a small app on your phone? Like for me, I have this backgammon app, you know, the game backgammon.
Yeah. I always see you play it on the plane.
Yeah, it's good because you don't need to be connected to the internet.
Yeah.
When I am connected to the internet, though, get pumped with ads.
Okay,
like
nice.
they're probably serving the ads there.
Yes, they would be.
Yeah.
So $1.5 billion in revenue in Q1, 40% growth year on year, expanding pretty quickly.
Yeah.
There you go.
AppLovin.
AppLovin. It's not about the name, Ren. Can't judge a book by its cover.
You just got to remind yourself that there are always more opportunities in investing. One day, AppLovin's going to walk past you, and you should at least do some courtesy DD on it.
All right, some other names. DocuSign seems to be back in favour. Another one of the 2020-2021 area, but that was for a different reason because of COVID. Ticker DOCU. I'm sure plenty of people are familiar with it. It's the online platform where you can digitally sign documents. So that's been picked up by a few of the big hedge funds. Taiwan Semiconductor, TSM, also picked up. That's obviously the semiconductor play for a lot of them, getting exposure to the semiconductor industry. Tapestry was added.
Luxury brands.
Luxury, yeah. So consumer, which is interesting given the timing that we're in, tariffs, the people thinking that economies are slowing down.
Yeah. I mean, it's up 200% in the past 12 months.
Investing's easy. Investing's easy.
So for people unfamiliar,
200%.
with Tapestry, it's kind of like America's response to LVMH.
Yeah.
A muted response, shall we say. It was made as a merger between a number of brands, but it includes Coach, Kate Spade, Stuart Weitzman. It's obviously done well. Luxury,
Wow.
I don't understand. I don't understand luxury.
We'll never get there, Ren. It's all right. And then the final one is Intuit. So it's like a financial services provider. Not financial services, but like
it's like a Xero.
Yeah, like accounting platforms.
Yeah.
And
QuickBooks
the
is their
like.
main product.
Yeah.
Intuit QuickBooks, yeah.
So again, picked up by some of the big names in Q1. So those are the common buys that we've seen. Now for some of the common sells. So the big one is Spotify. Ticker SPOT. No surprises here, I don't think, because of the run that Spotify's been on.
Yes.
Pretty impressive growth.
Yeah.
So I would say that these large companies, they're cutting back on exposure, not selling completely, which is a common theme. Palantir was reduced by Stanley Druckenmiller particularly. It's had a pretty heavy run. New Holdings was reduced by Berkshire and Stanley Druckenmiller. And then 3M, which we spoke about last time we did a cheat sheet, has been reduced by Markle, which is the smaller baby Berkshire Hathaway. And then to close it out, Meta was trimmed by a number of them as well, given the growth it's been seeing.
I mean, like you can put a number of those together. Spotify, Palantir, New Holdings, and Meta have all had incredible runs over the past few years. So unsurprising that people are taking money off the table. Also, some would argue, well, particularly for Palantir, the valuation is incredibly stretched.
Yeah.
600 and something price to earnings ratio. The market average is like 20.
Wow. Anyway, I think the takeaway here is the 13F is the resource that you can find all of this information.
No. Wrong takeaway.
Okay, what's the takeaway?
The takeaway is Equity Mates Investing is the resource where we will distill all those forms into bite-sized digestible content for you to take away and do your own research on. And if you want to stay abreast of it all, subscribe wherever you're watching or you're listening.
That's a much better takeaway.
A good takeaway.
Nice.
What about this as a takeaway?
Yeah.
They say don't judge a book by its cover.
Yeah.
Don't judge a company by its name.
That's pretty good.
One day AppLovin will walk into your life and give it some loving.
Give it some loving. Anyway, we've covered plenty today. A reminder, if you want to come and work for us here at Equity Mates, there are roles now available. Head to equitymates.com/careers to find out more information and you can start applying from today. We would love to hear from you. But Ren, that brings us to the end of today's episode. We'll chat next week.
Sounds good.
Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.